All right. Well, awesome. Let's go ahead and jump in. Dr. Harden, if you wouldn't mind introducing yourself here real quick, and then we'll jump in and I'll introduce myself, and then we'll kind of go through what we're going to talk about here today.
That sounds great. Thanks, Stephen. So I'm Dr. Frances May Harden, a full-time practicing ENT surgeon. And throughout my career, I've not only focused on providing the best high-quality care for patients, but I've also had to navigate the complexities of personal and professional finances, which includes taxes. And of course, as physicians, we're often caught up in the day-to-day of clinical practice, but, prioritizing our financial health and optimizing tax strategy are both crucial to, a long-term plan. And that's why I'm excited to discuss, tax strategy today and how it can significantly impact our careers and financial well-being in today's environment.
Awesome. Thank you. And like Dr. Harden said, my name's Stephen Gabrielson. I've been a CPA for going on 10 years now. I've specialized in a variety of different things throughout my career, mostly small business, tax, and accounting. More recently, I have, within the last 5 or 6 years, I've shifted the majority of my focus to tax strategy and how you can work with people who make a lot of money, whether it's through 1099 income or W-2 income, and helping them utilize the tax code to not only build long-term wealth, but also help them reduce their tax liability in the immediate need. So I've been doing that for about 5 to 6 years, and I've been a part of the DocWealth team here at DocWealth.io with Dr. Mark Applegate for going on about a year now. And we've been building a system and a process around tax strategies and a community around tax strategies specialized for those in the medical community. So I'm excited to be here to chat with you, Dr. Harden, about some different strategies that we can exercise, as well as maybe some things that you experienced as you were going through your journey. So let's go ahead and jump in. We'll first start the discussion by going through some challenges physicians face with taxes overall. And obviously we'll make this a discussion between the two of us as we go through this process here. But the main thing that I've seen working with physicians, especially people going from residency into attending, is the lack of financial knowledge going through that transition, going from making a little bit of money every single year to making a lot of money every single year, and how to navigate that from a tax standpoint and make sure that not only they're making good money, but also protecting that money. Would you agree that's a big issue that you've seen with a lot of people going through that transition?
Absolutely. There's that overall salary or annual income change. And then there's also a variety of wrinkles, which include, for many of us, the sign-on bonus and how things like that can be tackled. People are always kind of asking, how can I optimize, this portion of the sign-on bonus?
Absolutely. Yeah, absolutely. A big question that we always get here at DocWealth is the difference between 1099 income and W-2 income, and kind of how they're treated on a tax return, as well as what people can do to reduce their tax liability, especially when it comes to those sign-on bonuses. I know those sign-on bonuses can be pretty substantial most of the times. And so the tax strategies that we typically work with when we're talking about a W-2 individual versus a 1099 individual tend to be more around two main key strategies. And let me know if you have any background in either of these. But the first main one, sorry, do you have something that you wanted to jump in and say?
I think it'd be great to start with kind of defining those terms. There are certainly many resident physicians, younger physicians, earlier career, who may not know the basic difference between W-2 or 1099, or how to know which one of those applies to you.
That's a great point. So a W-2 employee is just that. They're an employee of a hospital. They get paid every 2 weeks, every month, depending on how their payroll is set up. When you get paid from that employer, when you're paid, that employer withholds federal income tax for you. They also withhold Social Security taxes and Medicare taxes, and usually state taxes as well, state income taxes. They pay the federal income tax into the IRS. They pay the state withholding into the state, and the Social Security and Medicare they also pay into the federal government for you. And what you don't see as an employee is that Social Security Medicare aspect of your paycheck is about 7.5% of your salary. up to certain limitations, right? Social Security maxes out at 169,000. And then the Medicare portion is about 3.5% of the total. But what you don't see is that the employer, the hospital, actually matches those numbers and pays in a full 15 to 16% based on those limits into the federal government. So that's a W-2 employee. A 1099 individual is known as a contractor. And as a contractor, you're not paid on a salary. You're not paid as a W-2 employee. They don't withhold Social Security and Medicare taxes. They don't withhold federal income taxes, and they don't withhold state income taxes. They just give you a check. And typically you take that check, you deposit it in your bank account, and then it's your responsibility to make sure that you're paying taxes on behalf of yourself for that income that you're generating. A lot of times when you're a 1099 contractor, and this is probably something that you understand much more than I do, you're on a contractual basis with the hospital. So you're probably getting paid per shift, or you're getting paid on certain parameters as you complete the work that you're required to do for those hospitals or for those institutions that you're working for. Is that a good explanation of the differences there? Any missing pieces that you want me to throw in?
Yeah, that's very helpful. And I just and to put it into layman's terms, because I myself, not an expert at any of this. And so I want to kind of bring it down to explain it like I'm 5 level, where my understanding, and correct me if I misstep, but, at the end of the day, and functionally for me, because I hope I never have to get so granular or expert at taxes myself. But what I know is that as a W-2 employee of the hospital does take out taxes from my paycheck for me. So when I just receive my paycheck, okay, I don't need to be setting aside extra on purpose to pay my taxes. Right, mostly. And as opposed to where the 1099, and where I've read and heard horror stories from physicians, from people online, is where they don't realize that they need to be doing that. And they're not budgeting appropriately, planning appropriately, and taking that out. And that's how, once a year they can really find that they are now in financial danger because they didn't plan ahead for this. They didn't maybe know to plan ahead for that.
Exactly. I've seen it multiple times where people who work with 1099 contractors, that contractor goes into April 15th to file their tax return, and they don't realize they have a $150,000 tax bill due. And not only that, you have a $150,000 tax bill due with penalties, with interest, with a whole bunch of other items that you need to make sure that you're taking care of throughout the year. So there's a lot more complexities when it comes to 1099 contractors. But at the same time, there's a lot more flexibility, right? You have the ability to take what are called deductions against that income to reduce your tax liability. If you were to run through a couple examples, W-2, people who make a W-2, right? You make $300,000 through a W-2. Right? You're not really able to take any deductions against that W-2 income. You can't if you buy your own scrubs, you buy your own little small tools and equipment stuff, you're not able to take those items as deductions against your W-2 income, right? On the flip side, if you're a 1099 contractor and you're making $300,000, you are able to take deductions for items that you're not reimbursed for from a hospital, right? So if you're buying your own scrubs, special shoes, small tools and equipment, if you're having to travel and you're not getting reimbursed for those things, you are able to take those as deductions against that income. And so on a tax return, instead of reporting $300,000, let's say you have $100,000 of expenses that you had to spend in order to generate that income, you're actually able to report $200,000 of income on your tax return. So you're able to save a substantial amount of tax from being able to do that, having the flexibility to do that. So that is another key difference there.
And then I guess one specific question I have is, what about the scenario where it's a W-2 physician, but then they are separately doing moonlighting or consulting work?
That's a great question. You actually have 2 separate reporting items that you would go through. You have your W-2 income that you would report separately on your tax return. Then you also have what's called a Schedule C item, or a small business item, that gets reported as what's called a sole proprietor on the individual tax return. And so let's say, for example, we have $300,000 of W-2 income, and then we have $100,000 of the moonlighting work. Okay. You would show your income in 2 spots. On the top line of the tax return, you'd have your $300,000 of W-2 wages. And then I believe it comes from Schedule 1, and they shifted this around on us, but I believe it's line 8. Front page is where your Schedule C, or your moonlighting income, would come into play. So you'd have a separate schedule on your tax return that's called the Schedule C that would show your income of $100,000. And then you would have your expenses associated with that money, your travel, if you had to buy anything special, all your small tools that you had to buy that you didn't get reimbursed for, you're able to take as deductions against that $100,000 of moonlighting income. So let's say you had $25,000 of expenses associated with it. You only have to report $75,000 of income. So you'd have your $300,000 plus your $75,000 to be a total income of $375,000.
And that's interesting because it's complex, but I feel like it does make sense when you think about that's almost more of like a hybrid. So yes, you're a W-2 employee, but then you also do this other work that is much more like, small business contracting. And you're saying that that person can still optimize deductions against the latter part.
Exactly. But you are able to drop it into a loss position, right? So for example, let's say you live in a big city like my brother lives in Philadelphia. He's a medical professional out there. For majority of his time out there, he didn't even need a car. He was able to walk everywhere, right? Let's say you get a job that's at a hospital 20 miles away, and you now need to go buy a vehicle in order to get to that job, right? As long as we can establish, and this is probably getting too deep into the weeds here, but as long as we can establish a home office as a main administrative office for your side, for your moonlighting business, there's a really good chance that we can take majority of the cost of that vehicle against the income of that's been generated from that activity. So if you're running $100,000 through your moonlighting business, you have $25,000, $30,000 of just general expenses, and then you go and buy a $50,000 vehicle or an $80,000 vehicle. There's a really good chance that we can eliminate all of that income and not have to report any of the income on that tax return. You still report it, but you had your $100,000 and all these expenses that then drop that into an actual loss. And then that loss can be used to offset your W-2 income.
Wow. And this is just even another point. I think that I know the answer, but just to clarify, so all residents and fellows are W-2 employees, like implicitly, that's my understanding of the system, right? So all of them are with the option that some residents and fellows are able to moonlight. I myself in training, we had it signed into our contract that we couldn't. So moonlighting never came up. I didn't have to learn about that or delve into any 1099 or kind of like deductions work as a trainee because some of us aren't permitted to. But I guess that you guys do have residents that you work with who even have that second portion. They aren't all just a straightforward W-2, although I would just imagine the vast majority of us as trainees are.
Yeah, I can think of 3 or 4 that I've talked to within the last 2 months that are doing that have been able to moonlight residency. And it is a great way to optimize your tax benefits, right? And we even see this outside the medical field, right? If you have a high W-2 earner in any other field, if they have a spouse that stays home and you do a married filing joint tax return, so all of your income between you and your spouse are compiled on one tax return. If the spouse moonlights or does a side business or does anything that generates income on the side, you're able to do the same thing. You can take deductions through that business to reduce that income tax liability. And a lot of times you can drop it into a loss position to then offset the W-2 income. The main issue that arises or can arise from this is you want to make sure that you're not dropping it into a loss every single year, right? Because you can run into what are called the hobby loss rules. And so if you're moonlighting as a medical professional and you're writing a ton of stuff off against that income and you're dropping it into a loss year over year over year, you can run into issues with the IRS stepping in and trying to say that it's more of a hobby rather than an actual business, right? In order to be able to claim deductions on a business, you need to make sure that you have an actual profit motive. And so if you're showing a loss every single year, it becomes difficult to show a profit motive there, right? So you can run into issues with that, but usually for the first few years of the business, you are able to operate at a loss and you're okay.
That's interesting. And then like continuing medical education, conference travel, where does that all fit in?
Yeah, those are all the very legitimate business expenses and deductions if you are moonlighting, right? Or if you're a full 1099 contractor. When you're a W-2 employee, typically your best bet is to go get reimbursement from your employer for those.
Right.
Because you're not going to be able to get a benefit from them on a tax return. So you do want to seek reimbursement from your employer for those items if you're a W-2 employee. Now, if you're a 1099 contractor, track your receipts, track your travel expenses, make sure you're tracking all of that because all of it can be used as deductions on your tax returns to reduce your tax liability. And those are 100% deductible.
Wow. And yeah, absolutely. You know, my experience as a W-2 hospital employed physician, I, like many people, have a specific CME budget written into the contract. So that just renews every 12 months.
Cool. And that's great to know. And another thing that's important, I think, for people to understand is when we say 100% deductible, we're not necessarily talking about you spend $100, you're saving $100 on tax, right? This is I find this to be a very confusing piece for a lot of people, right? When you spend $100 on your business to generate income, you get a $100 deduction, which reduces your taxable income by $100, right? It doesn't reduce your tax liability by $100. It reduces your taxable income by $100. Mm-hmm. So if your effective tax rate's 30%, then you've saved $30 instead of $100 on your actual tax liability. So hopefully that clears up first.
No, I think that's such a great point. Like I feel like my first introduction to that, I was probably like a senior resident when I was watching Schitt's Creek, and David, one of the main characters, he learns about write-offs. Not really correctly. He misunderstands them. And so, you know, he's buying all this stuff for his little general store, and he's like, this is a write-off. And his dad is like, yeah, but, you know, how are you going to pay for it? And he was like, it's a write-off. Like, it's free. So
people write it off.
Yeah.
Love that show.
So that's a helpful clarification. Like, thank you. Because, I mean, I feel like all I learned from that is that write-offs are not free, but your explanation helped me to better understand why that is.
Absolutely. Well, thank you. I'm glad it was helpful there, and thanks for kind of guiding the conversation into that direction. That was a good topic to go through. I tend to stay high level without getting into that whole explaining it like you're a 5-year-old type thing. So I appreciate you for pushing me to dumb it down a little bit more. Well, awesome. So should we shift gears into actual strategies that both W-2 employees as well as 1099 contractors can execute?
Yes, absolutely. And I feel like what I can offer is, you know, I live online. I'm a millennial. I know the keywords that people keep asking, you know, on Reddit over and over again. And of course, I'm sure you hear this all the time, but there are some basic questions that people have, like, okay, I keep hearing about the backdoor Roth IRA. So just very specifically walking through what that looks like for all of us as physicians.
Yeah, absolutely. I love it. So the backdoor Roth IRA is a great strategy for long-term tax savings, right? When you do a backdoor Roth IRA, you're not getting any tax benefits in the immediate year. What you're doing is you're loading money into a Roth IRA that grows tax-free, right? So what an IRA is in general, or what you'll hear a lot of terms around this. You'll hear IRA, you'll hear a SEP IRA, you'll hear solo 401k, you'll hear simple IRA. There's a lot of different retirement plans. And what all these are is they're basically government regulated retirement plans, right? Where you have to hold your money in those accounts until you're 59 and a half before you can start pulling your money out of that without having penalties and stuff like that. Obviously, you're free to pull your money out early if you want to. You're just going to have a 10% penalty on the amounts that you pull out. So sorry.
Oh, I apologize. Just 2 quick questions about that as they're coming up. So, number one, what is just a Roth IRA, and can physicians use that?
Yeah, great question. So there's 2 types of retirement accounts, right? There's traditional accounts and there's Roth accounts. And then you could do IRA, SEP IRA, simple IRA, 401k, all that stuff. So a traditional IRA, you put it into the IRA account, which usually is then invested into like the stock market, right? Depending on how you're managing it. When you do a traditional IRA, you get an immediate tax break in the year that you put it in. So if you put $6,500 into your IRA, you get a $6,500 deduction on your tax return. Okay. That is called a pre-tax deduction, right? Or a pre-tax contribution. You are paying that into your IRA before you're paying taxes on it. Now, as that account grows over the next 30, 40, 50 years until you're 59 and a half, When you pull that money out of that traditional IRA, you will have to pay ordinary income tax on it. Okay. So you put $100,000 in and it grows to $1 million by the time you're 59 and a half. When you start drawing on that money, you have to pay income tax on it, right? You got $100,000 tax deduction for putting it in over, I don't know, however many years you do that. The max that you can put in, I believe, is $6,500 for this year. If you are over the age of 50, you can do an additional contribution of $1,000. So you put up $7,500 in there. Double check those, because as you watch this video, it could be the next year, and those rates change almost every year. So on the flip side, when you're doing a Roth IRA is a post-tax contribution, meaning when you put money into a Roth account, it grows tax-free, and when you pull it out, you do not have to pay tax on it in the future, but you do not get a tax benefit from making that payment in the current year. Okay, so that's the main difference between a traditional and a Roth IRA. Now, there's a lot of limitations to when you are actually able to contribute to an IRA and get the deduction. Most physicians make over the limit. Let me actually look up the limit while we're sitting here.
Yeah, sure. That would be helpful. Because exactly, I mean, the implication is, and a lot of the conversations that, I've heard and been a part of, it's like, okay, I know the hot keyword is backdoor Roth IRA, but that obviously implies that we can't do the regular Roth IRA. And so, is that true? And why not?
Yes. Yeah. So there are income limits to whether or not you can put into an IRA. Now, there are income limits to whether you can put into a Roth IRA. You can always put money into a traditional IRA, but once you are over an income threshold, you no longer get the tax benefit. This is where the backdoor Roth IRA comes into play.
Right.
And so the actual limits for 2024 is $7,000 if you're under the age of 50, $8,000 if you're over the age of 50. Okay. So that's how much you can contribute to an IRA, whether it's Roth or traditional. Okay. Now
in the income limits.
Yeah. So your income limits, if you are single and you make less than 146, if you make between $146,000 and $161,000 a year, you can do what's called a partial contribution. So there's basically a phase out period, right? So as you get closer to the 161,000, as soon as you pass $161,000 of income or adjusted gross income, you're no longer eligible to be able to put into a Roth IRA. Okay. And so if you make it under 146, you can do the full $7,000 into a Roth IRA. Okay. And if you're married, you basically double, or not fully double them, but if you're married, the limits on married is 230,000. If you're under 230, then you can do a full contribution. If you're between 230 and 240, you can do a partial. And if you're over 240,000, you're ineligible for the Roth IRA.
And is that just like, that's for the year? So maybe you're not eligible, like you don't meet the income limit for this year, but what if you do in 5 years? That's okay.
If you do in 5 years, you can start making contributions to the Roth IRA.
I got you.
It's year to year.
Yeah, you're not like out forever. So that's interesting because I didn't know that. And some people almost talk as if, it's like, yeah, you're disqualified forever, having exceeded that.
And you're not. It's year to year. So now on the flip side, if you are doing a traditional IRA, like I said, you can always put money into a traditional IRA. There's just, when you are over a certain income limit, you no longer get the benefit, right? And so, for example, if you were covered by a retirement plan at work, so if you have a W-2 out of hospital and they provide you with a 401k or an IRA or something like that, your income thresholds are much lower, right? So if you're single, it's $77,000, right? So it's really low if you're single. If you're married filing joint, it's $123,000. And so if you're under that, you can do the full amount. If you're over, and then the windows are about $10,000 again. So between $77,000 and $87,000 is the phase out if you're single. So if you're over $87,000, you get nothing. If you're over $143,000 and you're married, you get nothing after that. And so this is where the backdoor Roth IRA comes into play, though, because even though you can't get the deduction for the traditional IRA contribution, because you're over those thresholds, you can still contribute to the plan. You just don't get the tax benefit. What people do is they'll put money into the traditional IRA, And then the following day, they do what's called a direct IRA rollover into a Roth IRA. You can make a conversion.
Okay. Oh,
and then usually in the year that you make the conversion, what you have to do is you have to pick up the income on your personal tax return if you got the tax benefit. And so where this comes into play and is quite beneficial for most people is you put money into the traditional IRA, right? You're over the income threshold, so you don't get the tax benefit. You then immediately roll it into a Roth IRA, and you don't have to pick up the income because you never got a tax benefit from the initial contribution in the first place. Does that make sense?
wow, I see. Yeah, it does make sense. And the other thing I wanted to ask about, you talk about how at 59 and a half and above, then that can be withdrawn without penalty. And then you mentioned it can always be withdrawn beforehand. You'll be hit with a 10% tax penalty. Is that right?
A 10% tax penalty, and you also have to pay ordinary income tax on it for traditional IRAs.
Okay, because that was my question. So you're saying 10% on top of what you would have paid.
Yep.
Either regular taxes.
Exactly. 10% on top of the ordinary income tax that you have to pay on the money that you took out. Now, let's say it's a Roth IRA, though, because that is only applied to money that you're getting a tax benefit from, right? So let's say you do a traditional IRA, you put $100,000 in, and then it grows to $200,000, and you pull $150,000 out. You're going to get hit with a 10% penalty on the $150,000, plus you have to pay ordinary income tax on the $150,000. So it's really steep. Now let's flip gears to a Roth IRA. If we have a Roth IRA and you put $100,000 in, and it grows to $200,000, and you pull $150,000 out, you only have a penalty on a $50,000 portion because the main contributions you never got a tax benefit for. You're only getting a benefit on the growth aspect of it, right? So that first $100,000 that you pull out, you don't have to pay income tax on it, and you also don't get hit with a penalty on it. So with Roth IRAs, you can make a distribution from your contributions, and you don't have to pay tax or get hit with a penalty on those.
But if you're waiting until a certain age,
if you
not get taxed on it?
If you're over 59 and a half and it's a Roth account, you don't pay tax on it, even on the distribution or penalty.
I got you. Yes. Okay. That makes sense. That seems very favorable. I get why. I get all the hype now.
Yeah, Roth IRAs are very popular. They're not my favorite vehicle, but they're very popular.
Mm-hmm. Well, I feel like, I guess that a lot of people, like in their at least early or intro conversations, or they may say, hey, you know what? I am a newer physician and I want to get started now. Like, what's a good way for me to get started? We hear a lot of these conversations. And I guess, like at DocWealth, that's something that your guys' experts can help anybody walk through or set up.
Absolutely. At DocWealth, we go through all the different options that you have. We have what's called a circle community, where we have an FAQ section where we break down in detail all the different tax strategies that are available to you as a physician, whether you're W-2 or 1099. And mega backdoor Roth IRAs are one of those. The differences between all the different retirement accounts, solo 401ks versus SEPs, all of that's included in there as well. So we do our best to go through and break it down as much as possible. And then we're also always there for questions. So you can always shoot DMs via the Circle community group. And we have a 48-hour turnaround time for all questions that come in. So we're really quick at responding. And we can even jump on 15-minute calls and stuff like that and go through any very specific individual needs that you need.
That's wonderful. And because, and I know that you like live and breathe this stuff, because I will tell you, just for me, the mere act of, or this thought of taking your regular IRA, putting the money in there, and then you say it pretty casually, you're like, then the next day convert that to a Roth IRA. Like for some of us, you've already just lost, like the activation energy for that could be significant. Right. And then it's really hard when you're stretched thin at work, maybe sleep deprived, especially for some of the trainees and like early career physicians. So that can be like, that alone, I think can be so daunting, such that even if they're like, that's a good idea, actually, I should mean to do that. And then, and then they don't make that jump. So I think that lowering the activation energy as much as possible with like a team of experts, or, this ability to kind of get a Q&A done within 48 hours, closed loop, that's a huge asset.
No, absolutely. And that's the exact angle that we took with it. And DocWealth was founded by Mark. Mark's the main driver that started DocWealth. And as many or all of you know, he's a physician, right? He's an ER doctor. And he went through the same issues that everybody in the medical field has gone through. And he just always knew that there needed to be a better solution for it, right? And that was his big key driver for wanting to start something like this to really add value to his colleagues. So we always have that in the forefront of our mind that you guys are all extremely busy. You guys don't have a ton of extra brain space just because you're bogged down with work, you're tired, you're working long shifts. And we like to do our best to pick up where we can and help out where we can. So that's a big key component of why we started DocWealth and why we're here.
Absolutely. And I think like it's so great to work with, physician created companies and experts because there really can be this easy lost in translation effect where I like to use the example of, I was having a conversation with a professional, an expert in their field, and we were talking about physician disability insurance. And they said to me, a lot of physicians think that it's going to be as easy as car insurance. And I was like, I will stop you right there because I don't know anything about car insurance. And a lot of us don't. Like, in terms of, is that managed by maybe like a family member or a partner or something like that? Like, you got to take it down 10 more notches from there. But I think it's so great what you guys do to really make this like, there's a sweet spot. I just, at least speaking for myself, there's a sweet spot. Like I like to learn and I don't want to have my head buried in the sand, but I also don't always have the headspace to dive really, really deep into and learn 20 new acronyms and become, an expert in a new topic. And so I think that you guys do a really good job of hitting the sweet spot for physicians. Because yes, a lot of us do want to know something. We aren't like, I'm just going to blindly pass everything off.
Right.
Don't tell me what's happening.
No, for sure. And that's, I think that's another really great point of working, like you said, with a physician founded business. Because throughout even this conversation, as I've been talking to you, you've had to ratchet me back multiple times from the discussions that I have, because I get so comfortable in my mumbo jumbo stuff that I talk about. I forget that not everybody else really understands the nuances of what I'm talking about. So working closely with Mark has given us the ability for not only myself, but the other CPAs on the team, to really make sure that we're talking to our clients in the way that we should, and really truly helping them out as much as we can. So
yeah, that's wonderful. I wanted to make sure, not to jump back into content, but there was one specific thing where I want to make sure that I'm being super clear and I'm not spreading misinformation or anything, because at the opening of our conversation, I mentioned that I am a W-2 physician and I kind of glazed over. I was like, anyway, the hospital takes care of my taxes for me. And that does not mean that there is no tax strategy or optimization or anything. And I just wanted to directly call that out and ask you, let's do, for the scenario that we have not discussed, which is a scenario of a straight W-2 employee, no moonlighting, no consulting, no schedule, one as you described type of thing. Like, what can that person do to best get started or maximize their deductions?
Great question. So there are two main strategies that we work with when it comes to W-2, high W-2 wage earners is what we call people in your situation, right? The two main strategies, again, it's very similar to talking about a 1099 contractor taking deductions against their income, right? We are able to make certain investments as a W-2 employee that create deductions that can be used to offset your W-2 income. Okay, and that's the key factors that we try to identify. What are those investments and how can we leverage them? Okay, and the two main ones that we work with are, first, what are called the Airbnb loophole, or the short-term rental loophole, and obviously that's built around real estate. And I'll get into that here in a second. The second one is called oil and gas investments. Okay, and a lot of people sit back and think, oh, those seem crazy, or those seem like it's illegal to do. And I'm here to assure you that they are not. They're not even aggressive. They are very black and white within the tax code on how we're able to leverage these things. And a lot of times, I think people get extremely scared when it comes to taking deductions on their tax return because they're terrified of getting audited or they're terrified of getting in trouble with the government. And I just want to reassure people that the tax code was literally written to incentivize people to do certain things. That's what the tax code is for, right? Obviously, it's to fund the government, but the government also wants its citizens to act in certain ways that help benefit the economy. Right. And so you'll see a lot of tax incentives built into the tax code that are to spur economic growth in certain sections, in certain sectors. The big one that we've seen over the last year is oil and gas. Oil and gas is a really cool investment that you can put a chunk of money into, get an 80 to 90% deduction from how much you put in. So if you put $100,000 in, you'll roughly get about $80,000 to $90,000 of deductions that you can use against your W-2 income without having to actually put out additional work. So that's a really popular one for a lot of physicians. And again, the reason for that is because it doesn't take a whole lot of extra work. Obviously, you want to make sure that you understand the fund that you're getting into. You want to do your due diligence on the investment to make sure it's a good investment because there's a million different oil and gas investments that you can do. But what you're doing in that situation is you're basically buying a sliver of a partnership that is actually running an oil and gas operation. So it's drilling into the ground, pumping oil out, and you're basically helping that company fund its small tool and equipment, its labor, its sand, water, lubricants, all the different things that go into setting up that oil and gas operation. And you get a big chunk of deductions in the first year that you make that investment to use to offset against your W-2 income. And just to run through a quick scenario on that, if you were to make $100,000 in a year, you took $100,000 of that and you invested it into an oil and gas fund, you'd be able to get, let's say, a $90,000 deduction. Instead of reporting $400,000 of income, you report $310,000 of income. So again, if your effective tax rate is 30%, you're saving roughly about $27,000, $26,000 worth of tax, right? So it's a big tax savings. Along with that, those investments kick off dividends every single quarter. And then you usually will receive what's called a return of capital. When they sell, they're going to sell that pump after about 4 or 5 years because those are the highest production times. And so after they sell it, you get your return of capital. So you get your $100,000 back as well as about a 10 to 15% dividend every quarter for that investment as well. So that's the oil and gas strategy. Was I pretty clear on that? Do you have any questions on that aspect before we move to the short-term rental?
No, that's very helpful. I hadn't heard of that before. And you mentioned that has been really popular, like in the past year specifically. Has that just always been around, but now it's very hot?
Yeah, so it's always been around, and it's been growing a lot as social media is kind of like the social media around tax strategies has become very popular in the last few years. And so you've seen popularity growing for that area as you've seen social media grow. It's been around for a very long time. And obviously, the government has always wanted to push energy efficiency and stuff like that. And so they've always pushed investments for that. And then it's one of the rare ones that you can take advantage of as a W-2 employee. And it's just like anything else. If you run in the right circles, you'll hear a ton about it and you'll feel like everybody's doing it. But then if you don't run in those circles and you feel like you've never heard about it before and it feels like this scary thing, right? So just so that everybody knows, it's something that people have been doing for a long time. It's kind of tested. It's true. You just want to make sure you go with a company that's been doing it for a long time. And I would shoot for the investments that are saying you'll get an 8 to 15% return rather than a 20 to 40% return.
Right.
Yes, 20 to 40% returns sound amazing, but usually it's higher risk because they're a younger company. Maybe they haven't found the oil yet. Maybe there's a lot of other risks that they're kind of going through that you need to be cautious of getting into it. So that's just my 2 cents. But any of these investments always go through a financial advisor. So we have a financial advisor that we work with for all our oil and gas investments that we connect you through within our circle community if you're interested in the oil and gas investment stuff. So it's important to do your due diligence on all of them.
Yeah, now you have me thinking like I'm not running in the right circles. I definitely got to check it out.
Yeah, oil and gas is awesome. It's definitely one to do a little bit of research on, for sure. Now, the second big one is what's called the STR loophole or the short-term rental loophole. And the reason it's called a short-term rental loophole is first off, because rental properties, when you have an actual physical rental property, that's an investment property. So you live in one home and you have a separate house that you're renting to somebody else. That's called an investment property or a rental property. those rental properties are depreciated over time. And so what that means is you're able to take a sliver of the cost of that house and you're able to take a deduction on that every single year. And it's cool because home values are too such as, for example, if you have a $350,000 home, your annual depreciation expense for that home is probably going to be around $10,000 to $11,000. Okay. And so what that means is if that house cash flows about $600,000 or $600 a month, you're going to have roughly about, what is that? $72,000 of income from that house every year. Okay. After all of your expenses, not $7,200 of income from that house every single year. Yeah. Your depreciation expense of $10,000 is going to show a tax loss of about, what is that? $2,800, right? So you're going to show a loss on that property, even though you have cash flow. So it's the main difference between book income and tax loss, right? We're able to show a loss on tax term, but we're able to have book income. We're able to actually generate cash flow from this property while showing a loss. Mm-hmm. With real estate, you can actually accelerate that depreciation. So instead of just taking $10,000 every single year, we can do what's called a cost segregation study on that rental property and actually front load a lot of that depreciation and take it anywhere from like $40,000 to $80,000 worth of deductions in that first year that you place that property in service. So instead of showing a $2,800 loss in that first year, we can show a $50,000 loss or a $60,000 loss from that rental property. Now, the tricky part is taking that $60,000 loss and being able to use it to offset against your W-2 income or your physician business income. Right. And the reason for that is because that loss that was created is considered a passive loss. And a passive loss can only offset passive income. A great way to look at it is the difference between active and passive is active income is anything that takes blood, sweat, and tears to generate. So your W-2 job, your 1099 contractor work, anything that you spend all your time to generate that income, that's active. Mm-hmm. Passive in general is called mailbox money, right? It's rental income. It's things that you don't materially participate in. Okay. Now, there are special rules within the IRS tax code that says if you have a rental property that has an average rental period of 7 days or less, then you're actually able to take the losses from that rental property against your ordinary W-2 income or your 1099 physician income, as long as you self-manage the Airbnb. So that is the tricky component is you do need to make sure that you self-manage it. So you do spend a little bit of time working on that property. But that would allow you to take that $50,000, $60,000 of losses against your W-2 income for that year.
Wow, that's incredible. And like the thing that jumps out to me immediately is, we talked about the hobby loss earlier because you can't just post these losses every year. But when we're talking about this in the STR world specifically, sounds like you could post a loss.
You can.
A loss every year without alert.
Yeah. Going back to the hobby loss rules, that's when it comes to like traditional expenses, right?
Right.
Let's say you have the grandma knitting sweaters in her basement, right? You have like the material and the revenue, and usually the material costs significantly more than the revenue. And so then you have this loss that's generated just from ordinary business expenses every single year, right? That's where you have to worry about hobby loss stuff. Right. Now, where in this situation, your losses are coming from what's called depreciation. Mm-hmm. Depreciation is usually caused from reinvestment back into a business. So we see it with construction companies all the time. Construction companies are consistently recycling large assets within their companies, right? They're consistently recycling trucks and excavators and bulldozers and all sorts of stuff that are massive $250,000 pieces of equipment, right? Every single time they buy a new one of those, they get to take a write-off against their income. Construction companies show a loss almost every single year because they're constantly reinvesting into the business and growing it, right? They're not going to run into any issues because they have a clear profit motive, but all their losses are coming from that depreciation aspect. Mm-hmm. Real estate, same way, right? You can have real estate properties that some of them are going to show income, but then you're going to buy an additional 1 or 2 properties throughout the year. That's going to drop the whole portfolio into a loss. So you can show a loss on that portfolio every single year and not run into any issues.
That's awesome.
Yeah, it's cool. It's a great way to build your long-term net worth while eliminating your tax liability.
I think that's great. And super helpful. Like now you can probably see the wheels are turning for me.
Yeah, there's a ton that you can do from a tax standpoint. And like I said, the tax return really is a roadmap to creating long-term wealth. Like the wealthiest people in the world have used that strategy time and time again. Like usually they do it within small business. Amazon's a great example. The reason you have an Amazon warehouse in every single neighborhood of this country is because Amazon's able to run at a loss by continuously building out these massive factories. And yet they're able to continually increase their delivery times. So it's better for their business, grows their business, and also they don't have to pay tax on it because they're continuously reinvesting it back into the business. And we're just doing the same thing with you individually. We're consistently reinvesting back into you, building either your real estate portfolio or your small business or your oil and gas portfolio so that you can make more money, but also taking those deductions from those initial investments to reduce and eliminate your tax liability in that given year.
Wow. Well, I love that. And I mean, like I said, I'm sold. I think that as physicians, a lot of us, would benefit enormously from the peace of mind of kind of these long-term financial health investments and the stability there, because a lot of us do deal with things like, even Medicare reimbursement cuts every year for several consecutive years in a row now, and we're looking at it again. So there's like a lot, and of course, a million other pressures on our time and on our finances. And so like this just truly, I think, goes a long way in terms of peace of mind.
Yeah. And that's the biggest thing that we at DocWealth try to push is like your job is stressful enough as a physician. Like let us take that stressful financial piece away from you as best we can. Obviously, we want you to have a solid educational base so that you understand what we're doing, because like you've said many times, you don't want your head in the sand. You want to know what you're doing on a tax return and with your financial picture. But here at DocWealth, we do our best to teach you what you need to know and then help pick up the pieces and move you forward in the best direction possible and hold your hand through that process as much as possible. So our team is eager and ready to work with any and all of you. If you're on the fence or just questioning it, don't hesitate. Reach out. We do free consultation calls, free 15-minute quick calls to see if we're a good fit. And we're always here to help. And we're looking forward to continuously building up DocWealth and making it better and better every single month and every single year.
That's wonderful. And what's the best way for people to connect with you online or book a consultation?
Yeah, so you can find us on social media. We're DocWealth.io, or our handle is DocWealth.io. You can also follow Mark Applegate at Dr. Applegate. I believe that's his handle. But you can also just search Mark Applegate. He'll pop right up on Instagram. He's pretty big there. You can also go to our website, it's DocWealth.io, and then you can schedule a consultation call right there on the main page. And so, yeah, like I said, we've got a lot of capacity. We're eager and ready to help anybody that we can.
Awesome. Well, thanks for having me today.
No, thanks for having me, and thanks for your awesome questions and this great conversation. This was fun.